Hi, everyone. Welcome back to the Intelligent Investing Podcast. I'm your host, Eric Schleien, and today we're going to dive really deep and do an update into a company I've been studying closely, Vistry Group, the UK-based home builder. And if you are a value investor, you're going to want to stick around for this one. If you're not familiar with the business model, I'd recommend you go listen to the previous episode about Vistry. This one is being done a few months later, and we have quite a bit to update you guys on. For full disclosure, I do own shares personally. My company owns shares for its sub account, and clients also owned shares in the company as well. Also, a quick disclaimer, nothing here is investment advice. Always do your own work and consult a financial advisor before making any investment decisions. So, we're talking about a business that could be massively mispriced by the market right now and sitting at a weird intersection of misunderstood catalysts, management stumbles, and hitting quality. Why Vistry and what is it? So, Vistry is a British home builder. They're publicly traded in London and they operate under a dual business model. And this is the key to understand that there's this sort of split identity of the business, which reveals the opportunity. So, you have these two segments, right? There's the traditional home building segment, and this is your typical, just think your typical home builder, right? So it's cyclical, it's going to be capital intensive, it's a low margin business, and you think land acquisition, speculative development, exposure to macro housing cycles, and it's not necessarily a bad business per se. Like you can look at some American home builders that use this model and have actually outperformed the S&P, but the returns on capital tend to be modest over time, and the asset turns are slow, and it's the part of the business Vistry is currently getting out of. So then there's a second part of the business, the partnership business, and this is, you could say, where the magic happens. The business is asset light, it's capital efficient, and crucially, it's tied into long-term demand from local governments and housing associations to deliver affordable homes. So return on capital employed is over 40% on a normalized basis. It grows multiples faster than GDP. The unit economics are also just structurally better. So you've got high barriers to entry due to scale, local relationships, and execution risk that others can't match. Vistry is by far the dominant player in the UK, and it gives them quite a big competitive advantage. Like I cannot start a competitor to Vistry tomorrow, try to also do a partnership business and compete with them. I don't have the local relationships and the track record that Vistry does. So what you've got here is a high return on capital machine, and it's trapped inside a business that the market mistakenly thinks is just another home builder. If you look back at not even the thesis that I pointed out a few months ago, but if we go back to when I was buying the stock in 2023, and it's not something, I don't think I talked about it publicly, but you could essentially say there was a few data points as part of the long thesis. So the first part was that partnerships in general are structurally advantaged world-class businesses when done right. And the company was transforming itself into a pure play partnership firm. If you actually look at the press release when they talked about transitioning to partnerships, the stock rationally shot up because of it. Now, the capital release from winding down home building would then be used to repurchase stock and turbocharge returns. If you follow NVR in the United States, which I have since I'm in high school, the playbook should sound a little bit familiar, right? You have an asset-light home building model, efficient capital deployment, relentless aggressive buybacks. But the punchline is that Vistry's partnership unit, you could arguably say, is actually better than NVR's. It's higher margins. There's faster growth, more runway, and you're starting at a lower valuation as well. At the start of 2024, the market had started to reward this strategy, and the stock rallied over 50%. Momentum was on the company's side. And then often, as happens in these transformational situations at companies, things got a little bumpy. So if you look at the most recent Q4 of 24, you had, I'm gonna break this down a little bit. So you had, at least on the surface, you had these 3 profit warnings in quick succession. So if you break it down right here, everything's going hunky dory. And then it's, oh, cost overrun. Oh, the costs are even more than we thought. Oh, there's another profit issue. So you get 3 of these in a row. People are saying, can we even trust the management anymore? Are any of these numbers even real? That's the surface point of view without really understanding what quite frankly, no, if that's the view that someone takes, they don't really understand what's going on. The root cause, there's a few things to break down here. So one is the root cause. The root cause is very simple. It was legacy house building. The South Division, which is where all the profit warning things came out from, was still run by home building veterans. So there was project level issues that had cost overruns. That was it. The CEO brought in an auditor to do a very aggressive third party audit when they discovered this. So originally they announced there would be a 150 million pound shortfall, and that after the audit, they raised it to 165. So they had to do another profit warning saying, hey, it's going to even be more than we thought. I'm going to get to the third profit warning in a second, but those two in and of itself, you could almost say are just one profit warning. So the way this works in the UK is that there's going to be a material change in profit projections. You don't wait till the end of the quarter to say that. You actually have to say it. I think it's within 3 days or something. It's a quite short-term legal requirement. So the moment they discovered this, they had to put something out right away. And because they didn't have an exact idea, they had to put out some number. So they estimated 115 million pounds. And then they did say in the press release, so if you read back to that press release, they say, we're going to do a full audit and then we'll announce the results once the audit's done. So they weren't hiding anything. And then the audit came out instead of 150 million, 165 million. Now you got to remember, this was on a $3 to $4 billion, I think it was close to 4 billion, sorry, not dollar, pound market cap company. So we're talking about a few percentage points of profit compared to the entire market cap of the company. Now here's the third part. The third profit warning really isn't a impact on profits. They basically said that there were some land sales that they were going to be deferring. So but they said they would sell it later. Now, there was an impact to that, but that's not really an impact because it's just instead of making profits in the fourth quarter, you're probably going to make profits in the Q1 or Q2 of 2025. So overall, you had less than 100 million pounds of actual cash that was an issue. The rest of it had to do with accounting noise. So whether it was project margin resets or contingencies or say over optimism from the old team, less than $100 million impairment. That's the thing you want to get clear about. And my video is getting a little wonky. They said they would sell it later. So if you look at these third profit warning, there wasn't any less cash involved. And if you look at what happened there, you had basically partners that said, "Oh, we're going to buy land from you, and you know what? We're going to buy this at a discount. You've already issued 2 profit warnings. You don't want to do a third profit warning. So therefore, just give us the land for less, and then you don't have to report any profit warning." Of course, the CEO was like, "F you, we're not going to do that." So he decided to walk away, choosing long-term value over short-term optics, chose to issue legally the third profit warning, even though it was deferred profit. And of course, these deals are now closing in Q1 and Q2 on original terms. So it was just a really sleazy way of some people try to take advantage of the company. The management did not bite. Now, despite this, where you have a tiny little impairment, the stock crashed over 60%. The market priced this as if the partnership business itself had failed, which it hadn't, right? This is a legacy business that's in liquidation right now. So if you look at where we are right now, and you fast forward right to 2025. This is April 25 at the time of this recording. Vistry has literally reaffirmed every single partnership metric. So 800 million pounds of operating profit, medium-term target. So say 2 to 5 years, 40% plus ROCE, return on capital employed, 12% EBIT margins, 5 to 8% revenue growth, all audited, double checked, triple checked, internally validated. The South Division has been completely cleaned up. Every single person on the legacy house building leadership has been removed. The company has accelerated its exit from speculative building. The CEO, Greg Fitzgerald, said more progress made in the last 3 months than the prior 12. And if you look at capital being returned, 38 million pounds of buybacks over the last 6 months, 92 million pounds more committed by early 2026. And the management has been guiding extremely conservatively, but also signaling flexibility to do more if cash flows improve. I think that's important to look at. This recent press release, they said, oh, we're going to have less debt this year than we will the previous year. They didn't give you an exact number. Why are they not giving an exact number? Well, they also said we're going to slow down buybacks. Now, the value investor in me says, I don't like that. I think you should keep the debt where it is because as you become more and more asset light, you don't need a lot of debt in the business to begin with. So I would say keep the debt, use all that money to buy back stock. However, the reality is they are signaling I'm not the target market here when they're doing that. The target market is the housing associations, the government clients that want to see that they're signaling being conservative. And that's important. And by doing that, they've also already signaled that in the second half of the year, cash flows are probably going to ramp up. What do you think they're going to do with that excess cash flow? Buy back stock. So all the numbers you're getting are significantly more conservative than they're going to be at the end of the year. I'll go into that in a bit. There's also these macro tailwinds, which quite frankly are pretty massive. So the Labor government has said they are all in on housing. And they had said that before they got into power. It's like politics, right? You don't always know when if someone says, okay, this is going to be our priorities for this term. Things can happen, right? There's going to be macroeconomic shifts. There can be political shifts. So you never know what's words and what actually will show action. This has been better than I thought it was going to be, quite frankly. The day before Vistry had their last earnings report, the Labor government announced an additional $2 billion incremental funding for affordable housing. They also announced that there's going to be regulatory changes to speed up approvals. They've been streamlining planning processes, which anyone who's been involved in home building in the UK knows that those are a pain in the ass, both on the regulatory approvals and the planning processes. It's quite inefficient in the UK. There's a help to buy program, which may return. And then there's also new national targets of about 1.5 million homes in 5 years. So you have a 40% plus ramp in supply needs. Guess who's best positioned to take advantage of this? Vistry's partnership unit. And the partnership unit, they sell to three kinds of buyers. They have private rental, PRS, which there's already been strong demand for. Then you have the open market sales, which you should see start to rebound this quarter, if not next. And then the one segment that was weak was affordable housing, and now this has been resolved. That third leg, the affordable housing, which had been weak, you could say it was soft due to funding uncertainty. Right. So about every 5 years, the government announces what they're going to do for affordable housing. So you didn't really know what they were going to commit to, even though they said they were committed to it. Again, you don't know. But now that's been resolved, and they said they want to do this very quickly. So that $2 billion, for example, they've already said they want to get that out in the next 30 days. That's wild. So all of these projections and numbers that Vistry is giving out does not include this. And that is significant to understand because already you got to imagine they don't want more profit warnings. So they're not going to give numbers that are aggressive. They're going to give numbers that are so damn conservative that if anything, you're going to have earnings beats. So if we do a little math, right, and the current market cap's about 1.75 billion pounds today, you have a current EBIT, not EBITDA, EBIT run rate of about 400 million pounds. They have a medium-term EBIT target of 800 million pounds. All very doable. These are not aggressive assumptions at all. Tangible book value today is 2.2 billion pounds. And that number is actually probably understated on the books because that land is probably worth a little bit more than what's on the books for. So you're talking just a little bit under 8 times tangible, I'm sorry, not 8 times, 0.8 times tangible book value. You're paying about a little under 5 times EBIT for 2025. And you're paying, depending on how they do, probably 2 to 3 times EBIT on medium-term targets. That's ridiculous. If you look at where partnership businesses transact, you're looking at 5 to 7 times book value On an EBIT multiple, 12 to 13 times EBIT. So if you run a simple model and say they hit their $800 million pound EBIT, let's assign, to be conservative, let's assign a 10 times EBIT multiple, right? So this is below private market value. Let's assign a 10 times EBIT multiple. That gives you 8 billion in enterprise value that you get to buy today for 1.75 billion. And that's assuming zero growth, which we obviously know is not going to happen either. So let's say it takes 3 years. That's a 3 to 400% return, 3 to 400% return with zero growth. And then it gets better because they're buying back shares daily. So the share count's shrinking, and every buyback at these levels is highly accretive. So if you're a shareholder in Vistry, this has actually ended up being a good scenario for you, even though on paper it looks like you've lost a lot of money. But this is why it was Joel Greenblatt who said this once, and he said value investing worked all the time, everyone would do it. The reason opportunities like these exist is that there are years where you're going to underperform, and sometimes significantly. When Charlie Munger has talked about how, or did talk about, rest in peace, how if you look at the great investors, there's years where they would be like in the bottom 10% of investors. And if you looked at Charlie's track record, he talked about that. And he said that if his track record had been in a major institution, he would have been fired. So to go back to Vistry, there's very few fund managers who are able to stomach a 60% decline in this portfolio. But because you haven't actually had any impairment to the partnership business, and you've had single digit impairment to the entire business, and the stock has dropped 60%, those buybacks are so accretive, below tangible book value, that say over a 5-year period, the shares are going to, my perspective at least, is the shares are going to be higher in 5 years because of all the stuff that has happened in the market's irrational response than if it didn't happen, which is wild to think about. Right? But that's a little financial engineering for you. So this is a pretty rare setup. Charlie Munger used to call this a Lollapalooza effect, right? Where you have a company, he would say the best investment returns you can get are when you can buy a company at a low multiple that's also growing. So you get the multiple expansion and you get the growth expansion. So here we have a compounder. This is not a company that's 6% ROE and barely profitable, right? This is a company normalized should do 40% plus return on capital. That has a very long runway for growth and a lot of tailwinds. So you have a compounder that's being priced as a distressed security. That's wild. It's not something you see often. I don't like the word no brainer because that's a word that can get people into trouble. There's two phrases in the investing world that I think get people in trouble. One is this is a no brainer, right? It creates a sort of arrogance that will have you miss confirming evidence. The other dangerous term is it's different this time, right? It has you start to justify why something's different, and it usually isn't. And the exceptions make the rule. So I'm always more interested in what could go wrong. I think the story's great. I think it's quite realistic, but I'm always looking, okay, what can go wrong here? And there's a few risks that I see of something that could go wrong. And I'm going to go through this one by one from my perspective. Again, do your own due diligence. I think the first risk is the execution risk. Winding down an entire house building business and doing it cleanly is not trivial. We saw that the fact that Greg Fitzgerald decided to let the old legacy management do its thing, that clearly did not work too well. And then he fired all those management, and now all of the costs go through him. So he's overseeing all that until the wind down is complete. So he took accountability for that, and that goes over to management credibility risk. But on an execution front, they're clearly managing it. They did proactively replace the leadership. They're accelerating the exits. and they're tightening project selection. So I would be shocked if you see more cost overruns. In fact, I'd say it's very highly likely you're going to have earnings beats, if anything, going forward. Management credibility, the projection, that's the look of it, of 3 profit warnings, even though I explained why it's really not that big of a deal at all. From an optic standpoint, obviously, it hurt. And they took accountability for everything. They did the work, they reaffirmed guidance, which is the big deal. And they're communicating clearly now. Boom. The buyback hesitation. I touched on this before that my first gut reaction to them slowing down the buybacks, I thought, well, I don't like that. That's a red flag. But again, they are not doing that for me. They're signaling conservatism to the government clients. And they're running a very long game here. They're using not like they're being very precisely imprecise. So they're going to say, yes, debt's going to come down this year, but they don't tell you how much. Cash flows are going to go up this year. They don't tell you how much. The reason for that is it gives them flexibility. Like I said earlier, once cash flows start coming in, once land sales start speeding up, as the partnership transition starts to speed up, which you're going to see quite significantly this year, and you're going to see affordable housing speed up quite significantly this year. And that's not my opinion. These are pretty set in stone things now. It's inevitable you're going to have higher free cash flow. It's to me that is a known. So with more free cash flow, even if it comes say in the second or third part of the year, that gives them more flexibility to buy back stock, even if they don't reduce the debt by a lot, because they don't technically need to reduce the debt by anything, and the business is fine. The last risk, which I actually think is the lowest risk, which is funny because I think the common, what's the word? The prevailing wisdom is that this is the greatest risk. And this is also, I think, where I differ from the market as a whole. I think the political risk is very low. UK, here's how I look at it, right? And just walk through my logic here. It is unlikely that you have major political risk when right now labor is pushing hard for housing. So the facts on the ground is the UK government is not well right now. They are going through a period of fiscal tightening. They have some major issues with the budget. There are some major systemic issues in that country. That's just the truth. And markets have been puking in the UK because of that. The UK valuation is super low just in general right now, and for good reason. But the other point to this is if you look at how much the government's saying we want to tighten, yet they're spending this kind of money and actually pushing even harder for housing. Imagine what it looks like when times are good. This is when times are bad, and they're pushing like this. So to me, that is a huge green flag. So there, you could say there's massive headwinds in the UK, but massive tailwinds for housing. So is it a no risk story? No. But I think if you just look at this from a series of probabilities, this is a heavily weighted coin flip. And it's one personally that I'm betting quite heavily on. I always like to think to myself, why does an opportunity exist? And I think that great investments often emerge from some kind of misunderstood security or misunderstood transition or one-time events that are projected into infinity in the future. Well, Vistry is not being valued on forward earnings or free cash flow. And I think the margin of safety is in your future cash flows. And you just happen to buy it at a price below liquidation value as well. But you have the company is being priced on fear. And it's fear driven by a segment that they're exiting, which is so ridiculous because that is a known. Like all the problems are in a business that's in liquidation. So the market is anchored for whatever reason to legacy homebuilder comps. Makes no sense whatsoever. It's looking at net debt ratios through the wrong lens. It misses the working capital dynamics of a partnership model. It ignores the capital at our return on capital employed machines that are worth a lot more. Not to overthink this, but this is just a behavioral edge, right? If you can see beyond the numbers, you have a massive edge. And when the narrative catches up to the numbers, my perspective is you're going to see a violent re-rating of the stock. And that's what I would expect. And as the buybacks continue, as the partnerships expand, as you start to have more free cash flow, margins inflect, investors are going to start to view this as UK's NVR. At some point, and unless the partnership business is just terrible, which that's the entire thesis. Look, if the partnership business is terrible, you still are buying this thing below liquidation value. And it's not a company losing money. A company does make money. Right? So if this went back to a traditional home builder tomorrow, you'd still do fine. You wouldn't do spectacular, but you'd be fine. But this is with the wild. If the partnership business just keeps doing what it's doing and they liquidate the rest of it, there's no way this could be valued like it is today. Because what, in 3 years, it's going to be valued at half times EBIT or 1 times EBIT? It doesn't make any sense. If they're using free cash flow to buy back stock and the thing just trades below tangible book value, what is it going to trade at 0.3 times tangible book value for a company that's massively profitable at 40% returns on capital? It would never get to that point. So it's only one of two options. Either the partnership business is a massive failure and then the stock is reasonably cheap like every other sort of UK home builder that's trading below book value, or partnerships works out, which I think it's likely since it's currently working out, and you do fantastic. Like, it's hard for me to fathom a scenario where this works out and you have the same valuation. It just wouldn't make sense. Literally would not make sense. And if it does, that's fine. They just keep buying back stock. If you made it this far, you obviously know where I stand on the business and obviously the valuation of the business as well. You have this policy backed cash machine hiding literally in plain sight. And you could say it's a classic case of temporary pain creating permanent opportunity. You rarely get a chance to buy a company at double-digit returns on capital at under 3 times EBIT. And it may not re-rate tomorrow, but when it does, I think you'd wish you loaded up when everyone else was scared, and that's intelligent investing. So I want to thank you for tuning into this extended deep dive on Vistry Group. And if you found this helpful, please leave a rating or review, share it with a friend who's into value investing or just mispriced securities in general. And if you want more of these breakdowns, make sure to subscribe. Till next time, I'm Eric Schleien. Stay patient, stay rational, and stay invested.